Check it. Click. I just bought stock. You just saw me buy stock. No big deal. I mean, you know, if I can do it, you can do it. Whoa.
So you don't want to buy stocks like that, right? So that,
No.
I mean, here's what it is. Here's what the advertisings are, is that, okay, well, buying stocks are easy. A baby can do it. They can do the research, and then they just click and point, and then next thing you know, you got a diversified portfolio. That is the last thing that you want to do with your money, is that, okay, well, what stocks do you buy, right?
Yeah, well, I was just thinking, I don't remember my kids buying stocks at that age, but I do remember the spit up very well.
Really?
That's real.
Well, yeah, they probably bought the wrong stock. I mean,
Maybe that was it.
right? He saw the wrong stock, and then you saw it plummet, and the next thing you know, he puked all over the, you know, the.
Maybe that's why, huh?
Yeah, that could be. Hey, do this right, okay? You don't want to gamble your overall life savings away. Get the book. What we're doing is a free financial assessment today, and also we're giving away Warren Buffett. Play the winner's game. Think, act, and invest like Warren Buffett. If you want to invest like Warren Buffett, one of the smartest investors of all time, get your hands on this book. We're giving it to you for free. If you're curious on what you should be doing with your money right now, when markets are at all-time highs, interest rates are pretty much at all-time lows, now is the time to act. Because if the market corrects, what's going to happen to your overall retirement if the market goes down 20, 30%? It will happen. We just don't know when. There's always going to be a correction. Markets hit all-time highs, they correct and hit all-time highs again. What is your strategy to make sure that you can protect the wealth that you built up? Get the book, or you can always call our number at 888-994-6257. That's 888-994-6257. Let's go to the true-false question. Let's see how you did here.
All right, here we go. Index funds and ETFs tend to have much lower internal expenses than retail mutual funds, thereby allowing you to keep more of your profits.
Yeah, that's absolutely true. So when you take a look at what type of investment that you purchase, you can buy a retail mutual fund, of course. They have a little bit higher internal costs. Or you can buy an index fund or an exchange-traded fund where you're buying the entire index, or you're buying all those stocks in that particular category. There's not a lot of trading, there's not a lot of turnover, and there's no active manager that you have to pay. And if you take a look at the statistics, most active management funds don't beat the index anyway, so don't play that loser's game, play the winner's game. But then it's what type of stocks that you purchase. How do you construct a portfolio? How much money do you have in stocks versus bonds? It's really what's going to determine the overall performance. So let's look at what types of stocks that you can purchase, and then let's look at the characteristics of these stocks, because you can buy small companies, you can buy large companies, you can buy growth companies, and you can buy value companies. And so then it's looking at, okay, well here, I want to make sure that I have all of these types of stocks in the portfolio, but then how much do I hold in each?
Well, that's right, and really you want international companies as well as emerging markets. So there's really a lot to consider here. But the point is, and a lot of you just pick one investment class, like the S&P 500. That's a common one, and that's a good one. I'm not saying that's not a bad one, but that's just one out of about 12 to 16 different asset classes that you're going to want to get into. And when you think about, let's say, growth funds and value funds, large versus small, they do have different characteristics, because smaller companies they're smaller companies, just like it implies, and they actually tend to have a little bit better rates of return, but they're more risky. And value over growth. Cheaper companies are value, growth companies are growing quickly, tend to be more profitable. The value companies tend to do a little bit better over time, but there's more risk. And Joe, when you kind of look at this graphically, I think that really helps you to figure it out.
Right. If you want to increase your overall expected return of the portfolio, here's what you need to take a look at. There's certain categories of stocks that are going to give you a higher expected return, because stocks are priced on risk. So if I look at, this is the entire market, and if I want to increase my overall expected rate of return, I want to make sure that, all right, I'm tilting my portfolio towards value in small companies. All right, I'm not saying put everything in small companies by any stretch of the imagination, or everything in value companies. But here, if you look historically over time, these have outperformed. Small companies have outperformed large companies. Value companies have outperformed growth companies. And the reason for that is there is more risk associated with those types of companies. companies. Think about it. If you're a small company, let's say that I'm opening up a garage and I need some capital. So I'm going to go to you, the investor, and say, hey, you know what? I'm going to start a small company. Would you please invest $200,000 of startup capital so I can invest and build a garage and I can do car washes, Jiffy Lube, or oil changes, or whatever the case may be. You're going to say, Joe, I would love to give you that $200,000, but I want 40% of your company. I'll be like 40% of my company, but that's my cost of capital. My cost of capital equals the investor's expected return. So let's say I don't open up one garage, I open up 50 garages and I have $10 million of revenue. You're going to make a lot of money because you own 40% of my company. If you give $200,000 to Google, which is a very large company, they're not going to give you 40%, right? They're going to give you 400th of a trillionth of a percent. So if I'm looking at constructing the portfolio, I want to make sure that I have different asset classes that I can get a higher expected return in the overall market just looking at the risk characteristics of the stocks that I'm buying. It doesn't make any sense to time markets or pick individual stocks, such as, hey, I think that pharmaceuticals are going to do very well because of the new healthcare bill because everyone has insurance. It's already priced in the market. You're not the only one that has that information. The whole market has that information. So when you're constructing your portfolio, just keep this graph in mind, making sure that you do have a little bit of money in small companies and value versus just the big, large growth companies that everyone knows. The Apples, the Microsofts, and so on.
Yeah, and you really do need to make sure you've got some of each. And Joe, that was a pretty good explanation. And really, we're not saying to go all small companies and all value, even though they tend to do better over the long term. The reason you don't want to go all in is they're also more risky. They're more volatile. It'll be more of a roller coaster ride. You really want some of each, but you want to make sure you have a slight tilt to small and value companies because your portfolio will do better over the long term. You also want to consider tax management, which simply means where are your assets located in terms of our retirement accounts, non-retirement accounts, maybe you got some Roth IRAs. Where those assets are located are going to affect how they're taxed. And Joe, that's another big miss that people are making is they're forgetting the tax component.
Right. Here's the problem. If you look at the taxation of the dollar, okay, if I can reduce the taxes on my income that I'm receiving for retirement, I can take less risk. And that is key when I'm trying to create retirement income. So we've seen this before. If you first-time watcher, here you go. You got tax-free dollars. That would be a Roth IRA. So every dollar that comes out of that account, you don't pay any tax at all. That's ideal. Then you have a taxable account, which is subject to a capital gains tax, which is right now 15% for most people. And then your tax-deferred assets, your retirement accounts, your 401ks, IRAs, all of these dollars come out as ordinary income. So when you're constructing a portfolio, okay, so then you have to look at the tax management of things. It'd be ideal if all of your money was sitting here because you never pay tax on any income that you're trying to create, but that's usually not the case. What we see is that all of the money is sitting in tax-deferred accounts, and every dollar that comes out of there is taxed at the highest of rates of ordinary income. But here's the catch, is that if I want to have real estate, CDs, things like that in the portfolio, bonds, I want to make sure that I hold them in my tax-deferred assets. If I have high flyers, if I want to invest in stocks, okay, such as smaller companies or value companies, I probably want to hold those over here because I could tax manage those effectively. Because as stocks go up, I'm going to pay a lower tax. If stocks go down, there's something that's called tax loss harvesting. There's a lot of different key areas. I just wanted to point this out again to make sure that you're not forgetting about the tax. Here's the deal. Come into our office, sit down with one of our certified financial planners. We're a fee-only financial planning firm. Absolutely no charge to take a look at your portfolio, to see how it's constructed, to see how you're tax managing everything. It's absolutely no cost. Here's the number, 888-994-6257. Call that for a free financial assessment with a board-certified CFP advisor or a CPA. We got to take a break. When we get back, I want to get into rebalancing your portfolio. How do you buy when stocks are low? How do you sell when stocks are high? How do you do this? That's what you should be doing. Most people don't do it, so don't go anywhere. Show's called Your Money, and it's Your Wealth.